Hello again, and welcome to our online video lecture series. This is Unit 3. We're going to talk about selling grain and livestock through forward cash contracts in this section. While those are only 12 slides here and should be able to complete this in one video segment, it's important that you probably understand as we preview into this one that selling through forward cash contracts might be the most prominent way that many producers price grain. It's one of the easier tools and kind of sets up as we go through how we're going to approach marketing for the rest of the term. So let's get to our content here. Again, you can all read the objectives here. This is, again, one of the more straightforward units in the course and should be laying a good foundation for some of the things that we're going to talk about later on. So first question is, why forward cash contracts? And what a forward cash contract is to begin with is we agree to deliver grain or livestock or milk at a certain price, at a certain location, sometime in the future for a specified price. And so you enter into a contractual agreement with your local elevator. In this case, let's talk about wheat for a moment. Let's assume that we had the opportunity, we harvest wheat obviously in June, but we had the opportunity to price some wheat for October delivery and gain, 35 cents on the current price. So if we would agree with our local elevator to deliver one semi-load of wheat, good quality wheat for October delivery, we would get a 35-cent premium to store it for that period of time. And so you would enter into that forward cash contract, and therefore the elevator would then be agreeing to pay you that 35-cent premium over the current price in order to store it that long. That's what a forward contract is. Very simple, very easy to enter into, and we'll go through some of the nuts and bolts of what that contract looks like. But the main objective of using forward cash contracts are these four things here. Is, again, capture pricing opportunities as they occur during the marketing year. And oftentimes you'll find, if you track the grain markets carefully, you'll find ebbs and flows in the market where you get the opportunity to sell grain before you've even planted it, or while it's growing, or as you feel like the growing season is going well, you can market more grain. There may be marketing opportunities for you to move grain before it's ever planted or harvested. Number two is that establishes a pay price and reduces your price risk. If you can sell grain at a profitable margin point, it reduces the risk of that price going down and therefore becoming unprofitable. As we talk about in ag finance, in this class we will go through it as well, calculating and knowing what your baseline or what we call break-even price and break-even yields. If you know what those are, that establishes your baseline points for beginning to market grain. You don't want to market grain on purpose at a negative position. So establish those break-evens so you know when to begin marketing grain whenever it hits those price points. You guarantee yourself a market outlet. No, that's not something particularly common around here. There are plenty of places to market corn, soybeans, wheat, livestock, etc. But there are parts of the country where they only take a limited amount of a certain commodity, and if you don't get a contract, then you may not be able to deliver it there. Again, not common in our part of the country, but does occur. So certainly be aware of that. And then occasionally increase the availability of borrowing capital. It's important that you can prove to a lender occasionally that you've got some revenue coming in that will be at a certain amount. You've already got those contracts in hand. The grain is already in the field growing or committed, and you already kind of know what your financial position should be, at least to some extent. And so you can prove to your lender that maybe you'll need some additional cash flow in order to make some things happen. So let's talk first about capturing pricing opportunities. Price grain when good opportunities are there. And the only way to know that is to follow the grain markets. There are times when you see that market ebb and flow. The last few years, that January, February timeframe has seemed to be a really good time where we saw some market rallies, and you had the opportunity to price the upcoming crop at a pretty profitable mark. Didn't so much happen this year in 2020, but some prior years before, June provided some pretty good pricing opportunities. So, but that doesn't always happen. It really follows how the market movements are, and occasionally you get those rallies that you have the opportunity to market grain. Most of the time, when you get to the harvest season, that's generally when we put in a lot of the lows. In August and September and occasionally October, we put in the yearly lows. We know grain is going to be plentiful and coming to market in many locations. And so those are typically your market lows and times that you would prefer not to have to price grain if you don't have to. But if you can market grain or market commodities 12 months out of the year, you'll have the opportunity to improve your average price. Next, let's talk about reducing price risk. Especially important for those of you who maybe are highly leveraged, meaning you're carrying a significant amount of debt. You've got to pay your inputs and much more commonly in that current marketing year, and you may not have a significant amount of cash on hand to keep cash flow moving. It's important to minimize your risk exposure from a price perspective. You can't afford to take those lows. So, that's important for you to be aggressive in your strategy and forward contracting your commodities. Generally speaking, if you're higher leveraged, your break-even price is higher than those with more equity. So you have to be very careful that you don't sell below your break-even. So reduce your price risk exposure. Limit the opportunity for that price to go down on you if you can avoid it. Now, I'm not talking about selling 100% of your grain. That's important that we get that out at this point in time. We're talking about selling small percentages of your grain at different times to try and hopefully, again, raise your average pay price. When we talked about sharing the market, not real common around here, so I'm not going to expend any more video time on that. But again, does occur in different parts of the country. And then we talk about capital availability. There are some lenders that will want to know what your marketing strategy is and how you're going to go about forward cash contracting, using futures contracts, using puts and options, things of that nature that we'll be talking about in this course through the whole entire semester. How are you going to do that in order to protect yourself from a financial perspective? So let's look at some contracting alternative. So cash forward sales contracts, the most common tool, probably the most common tool that we'll talk about in the course. A fixed price, subject to any discounts for moisture and quality. So lay, for example, that we had the opportunity to sell corn for March 2021 delivery. Currently August of 2020. We enter into a contract for 5,000 bushels of corn to be delivered for March 2021 delivery sometime during that month. Has to be number 2 quality or better, which means good quality grain, free from disease and insects and things of that nature at 15.5 moisture or less. That would be the terms of the contract for the quality of the grain. And in exchange for doing that, your local elevator offers you a pay price of $3.75 a bushel. Again, you enter into that contract, and then you have to make sure that when March 2021 rolls around, you've got 5,000 bushels to deliver at the agreed upon quality of grain, and you'll get the agreed upon price of $3.75. Again, your only risk at that point in time is, of course, the price could go up, but the price could also go down. So at least you've locked in, hopefully, a profitable price point for yourself. Secondly, you've got to keep your grain in good condition. And then thirdly, you do have to pay a little bit for storage if you have on your own operation. Now, if you've delivered that corn to the elevator at harvest time and you're paying storage there, your storage risk is eliminated at home, and some of the quality things are already met. Um, but of course, you're subject to whatever it costs you to store it at the elevator at that point in time, and we'll talk about those prices as well. So terms again are listed there at the bottom, and occasionally there's some terminology for disputes, which are pretty rare on those types of contracts. So be clear if you're not if you're not familiar with a lot of these in terms of a contract, make sure to ask questions. Lots of your local grain merchandisers at the elevators that you're probably going to work with use these tools all the time, and they want to get you the best price that they can. So they will make sure and answer any questions that you have. Be sure, though, that you leave yourself some wiggle room, and make sure and communicate with elevator managers if you anticipate any delivery delays, weather problems, and certainly if you harken back to 2012 when we had a complete crop failure, there were some forward contracts that didn't get filled, and there was some tough decisions that had to be made with elevator managers at that point in time. So just communicate well with them. Make sure that they're part of your team, just like your financial advisor, your agronomist, and so forth. Delayed or deferred pricing. Again, we're going to set the price sometime after delivery. So we deliver grain to the elevator and we defer the pricing and wait for the opportunity to price it later. So kind of gives you the opportunity to speculate on the price. Maybe you don't have enough storage at home. And there's really two types of these types of contracts, either a fixed basis contract. So we're waiting for basically the basis to hit a mark that we feel is profitable, and then automatically that contract is executed. Otherwise, have what we call a service charge contract. So we're basing the pricing on the local cash price. That service fee is charged every month that you delay actually pricing it, and the price is chosen minus the service fees sometime later. It's important to understand in both of those situations, you've delivered the grain already to the local elevator. They have frankly taken ownership of it. They may do whatever they want with it. But on the books, that they owe you money whenever you delay or defer your pricing to when you select that point in time. So you could also, on these types of things, you could do the same thing as a producer by selling that cash grain and buying a futures position, which we'll talk about later. So the fixed basis contract is whenever you think the basis is really, really strong, meaning far away from the futures contract or futures price, and you think it's going to weaken, and you have that feeling, and there's maybe some data that points to that. So generally compare and contrast these two pricing alternatives carefully. These deferred payment contracts, maybe that's essentially where you deliver grain, agreed upon price, and then you defer payment maybe to the following marketing year. And those are mostly meant for tax purposes. So you better understand your financial position well enough that cash flow is substantial enough that you can wait until that check arrives in the next marketing year or another quarter or whatever it might be. But generally, later deferred payment contracts are primarily for tax purposes. Next is what we call a minimum price contract. So we can take advantage of current pricing, retaining the right to sell at a higher price at a later time if the futures rises. So you're basically locking in a floor or a guaranteed minimum. Important to understand, and I'm sure you can infer, that lots of elevators are pretty hesitant to offer this as a contract option, and it's pretty clear why. Is essentially you're making them take all of the risk on the price. So not a lot of them are going to be willing to stick their neck out too far on lots of these minimum price contracts. They have the opportunity, because of the quality of grain that they're going to collect and then therefore turn around and market, to maybe protect themselves in the futures and options markets that maybe you don't do, but still the risk exposure is pretty high. So you have to really think about, if that opportunity is available, what price point works for you, and could you take advantage of that? But a few contracting guidelines, again, don't forget, this is a legal obligation. You're entering into a legal contract. So getting out of it is very difficult. It reduces risk, these contracts do, but it doesn't mitigate losses. So you could still have problems through the marketing year. And that's where you have to employ another risk management tool. We're talking about marketing as a risk management tool, basically. Also, you have to reduce your risk exposure and other methods, and that's where crop insurance and good storage practices and great management come into mitigating risk and other factors. Develop an approach to marketing grain. You have to start kind of putting benchmarks on how much grain that you want marketed, how much grain that you're willing to, or livestock that you're willing to price ahead of time, using this forward cash marketing feature in order to help reduce your price exposure. If we look at cash contracts versus hedging with futures, cash contracts on the left-hand side here, any quantity grain can be marketed. So we could forward cash contract 500 bushel, 250 bushel, or 25,000 bushel. There's no commission, no margin money, no fees. We'll talk about what margin money and commission fees are when we get to futures. And you really don't have to have a lot of market knowledge. Futures and options are decidedly more difficult to figure out how to use as tools. And that's why they're delayed a little bit later on the semester. We got to establish a baseline on how this works first. Hedging with futures, when you use futures contracts, those are traded for most of our commodities around here, they're traded in 5,000 bushel contracts. There's always going to be commission fees related, and margin money is put into an account, and you can never go below what the money is in your margin. Otherwise, you could be in trouble. You need good working knowledge of the commodities markets in order to use that futures exchange. And fixed prices, to the extent that you can predict the basis changes. There's a lot more to using futures contracts. They're a great tool, don't get me wrong, but you need to understand what you're doing with the futures contract much more. So when we establish a forward cash contract price at your local elevator, essentially what we're doing is taking the futures price, let's just say for easy math, December futures price at $4, your local elevator for December price grain delivery is at $3.75. So we're obviously at 25-cent basis below futures, and you enter into that contract for any number of bushels that you could possibly deliver at that December delivery time for $3.75. That's your forward cash contract. Again, we'll talk more about how futures impact all this as we go through activities that are related to this section, and as we get into futures trading in Unit 4. So that wraps up this video lecture. Again, I'll look forward to completing some of the activities that we will go through in class. And please, if you have any questions, please post in the Ask the Instructor discussion forum. Thanks for tuning in to this video.